notes, account and notes receivable. So how would you describe an account receivable or a note receivable in your own words? What is an account receivable? You can tell me via Microsoft phone, or you can also write it in the chat, however you prefer. What is an account receivable? Liang writes informal or not. What do you mean? Okay, you mean an account receivable is informal and a note receivable is more formal. Okay, yeah, but more generally, what is meant by a receivable on the balance sheet? What is it, and what is it for? Okay, it's an asset. Okay, it's an asset, and it shows that the company has the company will receive money in the future, normally from selling goods or providing services. Yeah, so let's go on. As Liang already said, accounts receivable are more informal, notes receivable are more formal, like typically like a bank loan, yeah, with an interest printed on it, yeah, as you see it here. Yeah. Accounts receivable are typically classified as current assets. Current assets are short-term assets, as you know, yeah, and they are related to the operating cycle of the business. Yeah, the buying of and selling of goods and services. This is the operating cycle, and accounts receivable typically belong to those current assets. Sometimes they are called trade receivables. Why are they called trade receivables? Because they result from trading. Yeah? Here you see the related journal entry. The first is related to when a business sells products on account. Yeah. So here you debit the account receivable. You debit the account receivable, and the account receivable is an asset, and the asset is up. When you debit an asset, it goes up, and credit sales revenue, and sales revenue increases your equity. Yeah? Sales revenue goes to the income statement and increases your equity. The sales revenue here is based on the selling price of the product. Yeah, it is not based on on the cost of the product, rather on the selling price. Yeah, and even if the customer has not paid, the business is allowed to record revenue here. And the second journal entry is related to lending money on a note receivable. Yeah, and here you debit note receivable and you credit cash. Yeah. If you look at the accounting equation, which elements of the accounting equation are affected here in the second case, second journal entry? What is note receivable? Which element are asset up, yeah, note receivable up, and asset down because cash goes down. Yeah. So generally speaking, why do firms sell on credit at all? Yeah? The question is, why do they sell on credit at all? And the answer is because it comes with a benefit. Because they get additional customers. Yeah, because some customers, they want to buy on credit. Yeah, maybe they do not have so much cash, or they prefer to buy on credit, and therefore sales and profit increases. So this is an advantage. Yeah, this is an advantage, but it also comes with a cost. You cannot collect from all customers. Yeah. Why do some customers not pay? And what is the reason? What is the reason? What is the reason? Why do some customers not pay? Can you tell me? Why do some customers not pay? You sell them something, they have bought on credit, but you never see the money. Maybe they yeah, okay, bankruptcy. Maybe they cannot pay. Exactly. Maybe they cannot pay, or maybe they do not want to pay. Yeah, some customers might be able to pay, but maybe they do not want to pay. So cannot or do not want. Yeah, so some customers might be able to pay, but they do not want. Yeah, and therefore selling on credit comes with a cost. Yeah, this cost is called the bad debt expense. Yeah, bad debt expense or uncollectible account expense. Yeah. So and you have to be aware of it. Yeah, it comes with the benefit, but also with the cost. And provide for bad debt, to provide for the fact that some customers cannot pay. And firms, according to the rules, to IFRS rules, firms have to set up an allowance. Yeah, and the allowance shows the amount of accounts receivable that the firms expect not to collect. Yeah? So expects. Not to collect. Yeah? And the allowance is on the asset side of the balance sheet. Yeah, again, this is the balance sheet. Yeah, so this is the balance sheet of the company. Let's say this is the balance sheet, and you have assets here, and you have liabilities. So, and on the asset side, there's gross accounts receivable, which is total accounts receivable. Yeah, and you have the net accounts receivable, and this is a negative sign. The net accounts receivable. This is what the company expects to collect. Yeah, so this is what the company expects to collect, and what I expects to collect. Do you remember what this kind of yeah, we have a specific no idea. How could you estimate the allowance? How could you estimate how could you estimate the total receivables you expect not to collect. Okay, Ray writes beginning allowance minus receivable write-offs plus bad debt expense. This is correct. Okay, but then I ask how could you estimate bad debt expenses? Because this is also kind of like subjective. I mean, on what basis could you form your estimate here? Okay, on time. Yeah. So the longer the accounts receivable are outstanding, the more unlikely it becomes that the customer will eventually pay. This is good. Or you could also look at customer credit information. Yeah, you could look at general or specific customer credit information. But time is also very good. Yeah. So based on time, or customer credit information. Okay. So the allowance shows the total receivables a firm expects not to collect. Yeah. Okay. So here we got the formula to calculate the allowance. Yeah. And essentially to come to the ending allowance, you start with the beginning allowance, then you subtract the write-offs, and then you add bad debt expense. Yeah. So this is the formula, and you should be aware that the write-off has no effect, no net effect. Yeah, on the write-off has no net effect on total assets or on net receivables or on net income. Why is this the case? It is merely the write-off. I write it in the chat. Is merely a realization of the allowance. Yeah. So the write-off is merely a realization of the allowance. Yeah. So, and that means the write-off decreases the gross accounts receivable, but it also decreases the write-off. Yeah, and but it also decreases the allowance. Yeah, but it also decreases the allowance. It decreases accounts receivable, but it also decreases the allowance. Yeah, so when you write off, an account receivable. This is negative, yeah, gross accounts receivable, but the allowance is also negative, yeah, because you realize what you expected to become true, yeah. So the net effect is 0, yeah. When you want to increase a bad debt expense, yeah, when you think, okay, there is, I assume that there will be in the future there will a customer will most likely not pay, yeah, then you debit bad debt expense, yeah, you debit bad debt expense, and you credit the allowance, yeah. Bad debt expense is an expense, yeah, and it goes into your income statement, yeah. Essentially, it reduces equity, yeah, it reduces your equity. There's down, and you credit the allowance, which means your assets are down, yeah, because when the allowance goes up, yeah, it is a contra account, and it reduces your assets, yeah. So this is when the negative effect on your equity and on your assets happens, yeah. But later, yeah, when you write off your uncollectible account for which you have set up the allowance, then actually there is no net effect, yeah, because here the allowance exactly offsets the account receivable, yeah. Are there any questions related to this, or does it make sense? Are there any questions? If there are questions, you can always ask, of course. No questions? Okay, cool. Then we go on here. Yeah. So we have the creditor, that is the party to whom the money is owed. Yeah, and the debtor, that is the party that borrows and owes the money. Yeah. And then we talked about we talked about factoring last session, yesterday. Can you remember what factoring is? What is meant by factoring? Ray Chan writes, are allowance for uncollected receivables and allowance for doubtful receivables the same? Yeah, that's essentially, this is the same. Yeah, allowance for uncollectible receivables and allowance for doubtful receivables is the same. Yeah, so so there is no difference. It should be doubtful. Yeah, but generally, you're right. Yeah, though there are many words for the same issue here. So back to my question. What is factoring? What does factoring mean? Okay, yeah. It is about buying or selling accounts receivable. So from the perspective of a firm, you have an account receivable and you want to speed up your cash flow, you can sell your account receivable. Yeah, to receive the cash earlier. Yeah, but the problem here is that it's quite expensive. Yeah, and that's why most of the firms actually do not do it. Yeah, it's a form to collect capital, form to speed up your cash flow. Yeah, but most firms actually do not use it because it's too expensive. Yeah, most likely it's used by firms who really who desperately need the money. Yeah, because otherwise they have a problem. Yeah, maybe they go bankrupt otherwise if they don't do factoring. Yeah. So here this is the journal entry when you do factoring. You debit cash. Yeah, you debit cash, and you credit your account receivable. Yeah, you credit your account receivable. Your account receivable goes down, and cash goes up because you're selling your account receivable. Yeah, you're selling your account receivable. But as you see here, yeah, the account receivable, the amount of the account receivable is much higher than the cash you get for the account receivable. Yeah, so there's a big difference, and the difference is the financing expense here. Yeah, so this is the difference, and the financing expense is actually, this is the high price you pay for factoring. Yeah, so this is the high price you have to pay, and this is an expense. Yeah, so an expenses decrease your equity. Yeah, because they go into the income statement. Yeah, they go into the income statement and reduce your net income. Yeah, it's a form of interest. Yeah, it's a form of, you're right. This is a form of interest, and it's a very high interest rate. Yeah? That's what I mean when I said it's expensive. Yeah, so it's interest. Does it make sense? Or are there any question here at this point? Okay. Then we go on. We have here. Oops. We talked about the receivable turnover and the collection period. the receivable turnover actually tells us how fast the number of times the average receivables are converted into cash. Yeah, and the higher the sales is in relation to your average receivable, the higher this receivable turnover is. Yeah, and related to the receivable turnover is this collection period here. Yeah, so this collection period turns the receivable turnover into a time span, and that shows how many days the receivables are outstanding. Yeah, and obviously the shorter the period, the better it is. Yeah, because it means that your customers are paying faster. Yeah, it means the customers are paying faster. More days, in contrast, may mean that your customers may have a problem with paying the bills. Yeah. Yeah. And also related to our accounts receivable, or more generally to current assets, is our current ratio, and this is current assets divided by current liabilities. Yeah. So here, this actually it shows whether a firm can pay short-term liabilities by selling its short-term assets. Yeah. So a higher ratio means the firm is able to pay its current, its short-term liabilities by selling short-term assets here. Yeah, so here a good ratio is about good is 1.5. So this is good. Yeah. Yeah. Do you remember how could you actually help? How could you foster the extent, or how could you extend the credit, or what could be your plan of action to extend credit only to credit-worthy customers? What did we say yesterday? Liang asks, do we need to memorize the formulas? I would, yeah, you should be able to memorize these formulas. Yeah, but we will do exercises, and then you will get practice. So how could you extend credit only to credit-worthy customers? Estimate their credit statement. Okay, good. Estimate their credit, or run run credit checks, which is kind of like similar. Yeah, which is kind of like run credit checks. Run credit checks. And how to speed up cash flow or maximize cash flow. Yeah, maximize cash flow, speed up cash flow. You could send. What could you do to maximize cash flow, to speed up cash flow? Here, you could send letters to your customers that are not paying or going to pay. Okay, this is the same. Yeah, again, very good. Yeah, so you. Yeah, here we have it actually. Yeah. Okay, good. Then we go on with an exercise here. We have an account receivable, a debit balance of 2,800, and the allowance for uncollectible accounts has a credit balance of 400. A 90 euro account receivable is written off. What is the amount of net receivable after the write-off? Think about it. For a couple of seconds or minutes, and then we talk about it. When you're not sure, you can also go back in the slides and look it up. Maybe it will help. Try to answer the question on your own. So take a couple minutes if you need them, and then tell me what your answers. See, okay, let's, if you go back, gross accounts receivable minus the allowance equals net accounts receivable. Yeah, so and so if you start here, you have 2,800, which is gross accounts receivable. Then you have the allowance, which is 400. And if you do that, then you have net accounts receivable of 2,400. The question, of course, is what happens with the write-off? Yeah, we have a 90 euro account receivable which is written off. What does the write-off with our numbers here? It reduces our gross accounts receivable. Yeah, it reduces our gross accounts receivable, but it also reduces our write-off. Yeah, so this is why we set up the allowance. Yeah, that we can reduce it when the incident happens that a customer is not paying. Yeah, so after the write-off, yeah, after the write-off, what do we have? We have 2,710, yeah, which is 2,800 minus 90 minus 310. Yeah, because the allowance also has to be reduced. The allowance also has to be reduced, and the result is 2,400. So it's D. Yeah. Do you get the point? Do you get the point now? Why it is not C but D? It's not only that you have to reduce your gross accounts receivable. You also have to reduce the allowance. Yeah, and therefore the net effect is 0 here. Or are there any questions? Are there any open questions here? Does it make sense now? Or are there any questions? So the net account receivable actually does not change because of the write-off. Yeah, it does not change because it affects the gross accounts receivables. It affects the gross accounts receivable, but it also affects the allowance. Yeah, and the net effect is essentially zero. Yeah. Okay, if there are no questions, you can always ask. Yeah, but if there are no questions, we go on to the next exercises. And this is the next. Here we have net sales total 803,000. Beginning and ending accounts receivable are 80,000 and 74,000 respectively. Calculate day sales and receivable, the collection period, please. So first of all, take your time. Yeah, you can look up the formula. Yeah, it's here. Yeah, you can look up the formula to solve this this exercise. So take your time to answer this question. So here we have to calculate the collection period. Yeah, we have to calculate the collection period, and if we look at the if we look at the collection period, we see that first we have to calculate the receivable turnover ratio. Yeah, we have to calculate the receivable turnover. And then when we have the receivable turnover, we can calculate the collection period. So the receivable turnover is sales divided by average receivables. Yeah. Sales divided by average receivables. So what is our sales here? Sales is 803,000. Exactly, right, John? 803,000 is our sales. And we divide that by average receivables. And average receivables is 80,000. 80,000. Yeah. Plus 74,000 divided by 2. Yeah, so this is and this is the receivable turnover. Yeah, this is the receivable turnover. And we first have to calculate this to come to the collection period. Yeah, so this is the first step. This is our first step. And the answer here for the first step is 10.4. So 10.4 is our receivable turnover. Yeah, but this is not the correct answer to the question, because the question states that we're gonna have to calculate the collection period. Yeah, and the collection period is receivable turnover divided, which was receivable turnover was 10.4. Receivable turnover. Sorry for that. Receivable turnover was 10.4. And to come to the collection period, to come to the collection period, we're gonna have to do 365 is the number of days, divided by 10.4. Yeah, divided by 10.4. And if we type that into our calculator, we type that into our calculator, 3 divided by 10.4. We have, yeah, Yang and Raychan are correct. 35 days. 35 days. That's the number of days an average customer needs to pay the bills. Yeah, and from our perspective, that's the number of days we need to collect the money. Yeah, yeah. So if we go back here, we have calculated the receivable turnover. Yeah, which is, this is what we have done: sales divided by average receivables. Yeah, And the answer for the receivable turnover was 10.4. This was 10.4. And then we made this, 365 divided by the receivable turnover. And our final answer is the days sales outstanding. And this is the 35 the 35 days here. Yeah. So actually, it was a two-step answer. Yeah. Okay. Does that make sense to you? Yeah. Okay. Good. Very good. I see you are with me. Yeah. So when we are talking about cash and cash equivalents, we first have to define what cash equivalence is. Yeah, cash is clear. Cash, everyone knows what cash is. Yeah, but what is cash equivalence? Yeah, and it is defined as non-monetary monetary assets without physical substance. Yeah, but essentially it is assets that are very bank account. Yeah, bank account is cash actually. Bank account is cash. I would say the bank account is cash. Yeah. But what is cash equivalent? And this is short-term high-grade government securities. High-grade government securities. Yeah, so this is so high-grade government securities. This is short-term bills, yeah, of the that are issued by governments. Yeah, short-term bills that are issued by government. They are very similar to cash. That's why they are called cash equivalents. Yeah, because they are very safe. They do not move a lot. They do not fluctuate a lot, and you can take them or sell them every day, and you get converted into cash. What is national debt? Yeah, exactly, national debt. But short-term securities. We are not talking about bonds. Bonds are long-term. We're talking about bills, which are short-term. Yeah. So what is about checks? Checks are also cash and cash equivalents. Yeah, exactly. Yeah. So checks are also in this category. Yeah, correct. most companies have several cash accounts, and they combine all into one, which is called cash and cash equivalents. And there are also high grade government securities, bank deposits, and cash, of course. Yeah, and it is important from an organizational point of view for companies that you do not do not let one person do both cash handling and accounting in one person. Yeah, because to control the person, you have to do the accounting. You have to separate the accounting from the cash handling. Yeah, then it is because actually the problem with cash is that cash is easy to steal. Yeah, and it makes it easier to steal if you let do both the cash handling and the accounting do by one and the same person. That's why it's better if you set up a company to not let do both the cash handling and the accounting do the same person as a means of internal control. All right. I suggest we do a break here. Break. A break. 50 minutes. So see you in 50 minutes. See you soon.